Ever imagine tripling your money on Tesla? Outsmarting like the British pound, or even building a real estate empire basically from scratch? Well, today we're going deep into that world of investing, guided by legends who've actually done those things.
And we're going straight to the source for this. David Rubenstein's book, How to Invest. He sat down with, these absolute titans across venture capital, real estate, even distressed debt, which most people don't even understand.
You've given us this awesome collection of his interviews, and our mission, I think, is to distill it all. Decades of experience into key principles, surprising anecdotes, that wisdom you just won't find in some textbook.
Yeah, but even before the specific strategies, we've got to start with, the most basic question. What is investing? Rubenstein kind of nails it in his intro.
Okay, hit us with it.
He boils it down to predicting the future and then taking action. Not just following trends, but actually forming your vision of what's coming and then actually putting your money where your mouth is.
Makes total sense. It's bigger than just stock picks. It's like a whole mindset. And that future you're predicting could be in so many areas. Public equity, sure, but real estate, crypto too, which Rubenstein mentions.
Right, the possibilities are huge EE. So to make sense of it all, we'll explore different approaches, starting with Ron Barron, founder of Barron Capital. He's all about long-term, growth-focused investing.
And his Tesla story is just wild. Invested $380 million, his profit's already $6 billion. That's what, over 15 times his money back?
Yeah, but the fascinating thing is how he got there. It wasn't just, dumb luck. He saw potential in Tesla when most people were skeptical, betting on a visionary leader, Elon Musk.
Makes you wonder, what did Barron see that others missed?
He looked past the immediate challenges, I think. Dug deep into Tesla's tech, the potential, to really disrupt the auto industry.
Yeah.
And Musk himself, that drive to innovate. He was convinced Tesla would redefine transportation, willing to bet big on that.
Takes guts to go against the grain like that. And speaking of going against the grain, let's talk about John Rogers Jr., founder of Ariel Investments. He's the master of value investing, finding those hidden gems the market's undervaluing.
Embodies that classic Warren Buffett principle. Be greedy when others are fearful. He's got a knack for finding companies with solid fundamentals, but their stock price is, temporarily down, swoops in during downturns like the '87 crash, even the COVID crisis.
Everyone else panicking, he's seeing opportunity. Must take some serious discipline to stick to that.
Yeah, value investing isn't about quick profits, it's about the long game. And speaking of long-term strategies, let's move to real estate. John Gray, president of Blackstone, built the world's biggest real estate investment business, basically.
Some incredible deals, but that Hilton Hotels one, they bought it right before 2008. Talk about bad timing.
It was a gutsy move, for sure. Many people thought they were, done for. But Gray had conviction, strong belief in his analysis, believed in the Hilton brand long-term, held on, weathered the storm, and turned it into one of the most successful real estate deals, I think, in history.
Wow, talk about resilience. But real estate seems so vast. What exactly are we talking about when we say real estate investing?
It's more than just buying buildings, right? There's a whole spectrum of strategies, different risks, rewards. Gray breaks it down like core plus, value added, and then opportunistic.
Okay, break that down. Sounds kind of like bond ratings or something.
That's a good analogy. Think of it this way. Core real estate is your safe investment-grade bond, lower risk, lower return. Think prime office buildings, long-term leases. Opportunistic on the other end, that's more like a high-yield bond, risky but potentially big returns. Distressed properties, developing raw land, that kind of thing.
Strategy for every risk appetite, then. Choose your own adventure. But now, let's get to something scarier for most people. Distressed debt. Bruce Karsh, co-founder of Oaktree Capital Management. A legend in this space. What's the appeal?
Seeing opportunity where everyone else sees disaster, basically. Karsh's firm, they specialize in buying debt at a discount, when companies are struggling, profiting from other people's misfortunes.
You're betting they'll turn around. Seems incredibly risky. How do you even begin to assess that?
Meticulous analysis, deep understanding of the company's finances, the industry, the whole economic climate. Karsh and his team, they're experts at identifying companies that have strong assets but just temporary financial problems. They buy that debt cheap and then work with the company to restructure, sometimes even taking ownership along the way.
So not just passive investors, they're actually getting their hands dirty, turning things around.
Right. And Karsh has shown it can be insanely profitable, especially during market turmoil, like '08. Capitalizing when everyone else is running scared.
Fascinating how different investors see the same market so differently. Let's switch gears now to venture capital high-stakes world. Michael Moritz, partner at Sequoia Capital, known for picking winners.
Their portfolio reads like a who's who of tech. Apple, Google, YouTube, and so many more. Early backers of Airbnb, Stripe, long before they were huge.
They're not picking companies, they're picking the future, basically.
They have this almost legendary ability to spot potential early on, even when it's just, a glimmer. One famous example, Trip, the Expedia of China. They saw the potential of that Chinese travel market way before anyone else.
What's their secret? How do they consistently find these winners?
Rigorous process, deep understanding of tech trends, looking for companies that can create huge value long-term, one of their key criteria. The 2020 rule.
2020, what's that all about?
They're looking for investments that could generate 20% returns every year for 20 years. They're not interested in quick flips. They're looking for companies that can transform industries, create lasting value. And it goes beyond the numbers, right? They're looking for exceptional founders, clear vision, strong teams, the grit to overcome challenges.
Betting on the jockey as much as the horse. Now, let's dive into hedge funds. High rewards, high risks. Ray Dalio, founder of Bridgewater Associates, a legend. What sets him apart?
He's a huge proponent of independent thinking.
Yeah.
And having a system, a process for decision-making. He believes in constantly, challenging assumptions, testing ideas, making decisions based on data, logic, not emotion.
Almost like taking the human element OUT of investing.
In a way, yeah. He's known for his unusual beliefs, like radical transparency in his company, where everyone critiques each other openly. He also credits a lot of his success to transcendental meditation. He says it helps him think clearly and make better decisions.
That's a unique approach, for sure. But it's worked for him. Bridgewater's the largest hedge fund in the world. He's had his setbacks, too. He went broke back in '82.
Yeah, that experience was a turning point, forced him to really confront his weaknesses, build a stronger philosophy. He learned to embrace mistakes, see them as learning opportunities.
Amazing how those setbacks can shape you. Speaking of unique approaches, let's talk about Seth Klarman, founder of Baupost Group, another hedge fund, but contrarian.
Klarman is all about that margin of safety, buying assets way below their real value. It's like a buffer against losses. He's willing to hold lots of cash, just waiting for opportunities when the market messes up.
He's like the anti-FOMO investor, calmly waiting to pounce.
Exactly. And he really believes in understanding the psychology of investing. He recommends books by behavioral economists like Daniel Kahneman to understand how our biases, our emotions, can mess us up in the market.
So these investing giants aren't just financial wizards, they're students of human behavior.
Absolutely. Understanding that psychology is just as important as understanding the numbers, to make smart decisions.
And speaking of smart decisions, there's John Paulson, the guy who bet against the housing market in 2006. Supposedly made billions for him and his investors.
It was a bold move, no doubt. While everyone was riding the housing boom, he saw the trouble coming and was convinced it was going to crash.
Takes serious conviction to do that, especially when everyone's optimistic. But short selling, betting against the market, that's super risky, right?
One of the riskiest things you can do.
Yeah.
If the market goes the wrong way, you can lose everything. But Paulson, his analysis was spot on, and it paid off huge. He's become known for that contrarian approach, finding those opportunities that others just completely miss.
It seems like that ability to see what others don't is a key theme here.
Independent thinking, deep research, and the guts to go against the crowd. And it's about constantly learning and adapting, because the market's always changing.
So we've talked public equities, real estate, distressed debt, even venture capital, hedge funds, that's a lot. But investing keeps evolving.
It does. And up next, we'll dive into some of those new frontiers. The trends reshaping the whole financial landscape, basically. We've talked about, the traditional stuff, but what about the new frontiers in investing? One that's been making a lot of noise, and for good reason, I think, is cryptocurrency. Michael Novogratz, formerly of Fortress Investment Group, he's a big believer.
Crypto, yeah, it's been a wild ride. What makes him so bullish on it? Especially Bitcoin.
He sees Bitcoin as more than just speculation. He thinks it's like a revolutionary tech that could really reshape the whole global financial system. Even predicts its market cap will go over, get this, $10 trillion, replacing gold as a store of value.
Replacing gold, wow. That's a big prediction. What makes him think it can reach those kind of heights?
He points to a few things. Limited supply, it's decentralized, and it's becoming more accepted as a real asset. He thinks as more institutional investors, even governments, get involved, the value will just keep rising. He even compares it to, the early internet days, a transformative tech with huge long-term potential.
It's definitely something to watch. But let's shift gears to another new thing that's been shaking things up: SPACs, those special purpose acquisition companies. Betsy Cohen, the founder of fintech Masala Ventures, she's been a pioneer in this. What makes SPACs so interesting?
They're kind of like blank check companies.
Yeah.
They go public with the goal of buying a private company. So it's a faster, cheaper way for that private company to go public compared to a traditional IPO.
So instead of that whole long IPO process, they merge with the SPAC, boom, they're publicly traded.
Exactly. And it's been getting a lot of attention,
Mhm.
especially lately. Tons of big companies going public this way.
But I've also heard there are some concerns, especially in, choppy markets.
Right. One big challenge is getting the money to actually do the acquisition. After a SPAC goes public, they usually need to raise more capital, what they call a PIPE, private investment in public equity. And when the market's volatile, that PIPE funding can be hard to get, which puts the whole deal at risk. Investors are also getting pickier about which SPACs they're backing, looking at the track record, the expertise of the people running them.
So opportunities and risks, like anything new. Now let's talk about something that might sound kind of boring to most people: infrastructure investing. But Bayo Ogunlesi, the chairman and CEO of Global Infrastructure Partners, GIP, he highlights why this is getting so attractive.
Infrastructure. Your roads, bridges, airports, utilities, it's a backbone of any modern economy, right?
Yeah.
And these assets, they tend to last a long time. They have pretty predictable cash flows, which makes them good for investors looking for stable long-term returns. And as governments everywhere are struggling to pay for these big projects, private investors are stepping in to fill the gap.
A marriage of necessity, almost. Governments need the money, investors want stability.
Exactly. And GIP is a great example of how private investors can bring more than just money to the table. They're also bringing their expertise in, like operations, technology, customer experience, making those projects better.
It's like bringing a private sector mindset to the public sector, which can be a good thing for everyone. We've seen these different approaches, from the old school to the new stuff, but some themes keep popping up: conviction, long-term thinking, adaptability. What other big takeaways have you noticed?
One thing that's been super clear, being an independent thinker.
Hmm.
Almost every investor we've talked about has said this. They don't just follow the crowd. They trust their own analysis. They're willing to go against what everyone else is saying.
Like Ray Dalio with his whole system, or Seth Klarman waiting for those market crashes. It's about having the guts to be different.
Totally. And that ties into another important skill, seeing opportunities where others see only risks. John Paulson betting against housing, Bruce Kirsch buying up that distressed debt. They're taking calculated risks that other people are just too scared of. It's about doing the opposite of what everyone else is doing.
And a lot of times those contrarian bets are the ones that pay off the biggest. But it's not about being reckless. It's about understanding those risks, mitigating them through really good analysis.
It's like that saying, right? The biggest risk is the one you don't see coming. Knowledge is power, especially in investing. And that knowledge, it goes beyond just the numbers, the financials. It's about human behavior, market psychology, even like geopolitics. These successful investors are always learning, adapting, evolving.
They're like chameleons,
Yeah.
blending in but always ready to strike. But it's cool that they're not just number-crunching robots. They're real people. They have passions and quirks.
Exactly. Like Michael Novogratz with his wrestling background, or Orlando Bravo, the tennis prodigy turned software buyout king. It shows that there's no one right way to be successful in investing. And those passions can fuel their drive.
And a lot of them are not just focused on money. They're into philanthropy, giving back.
Like Orlando Bravo with his hurricane relief work in Puerto Rico, or Ron Barron supporting education, the arts. It's inspiring to see that generosity, using their success to make a difference.
It adds another layer to their success. But as we've been looking at their insights, one thing to keep in mind is that what works for one person might not work for another. There's no magic formula.
It's about finding your own style, your own thing, building a strategy that matches your goals, your risk tolerance. And like you said before, that future is always changing, so staying curious, informed, and being able to adapt is key.
Because change is the only constant in investing. Now, what about this ESG investing trend? It seems to be gaining a lot of traction, especially with younger investors. Have you been following that?
ESG, yeah. It stands for environmental, social, and governance. It's basically a way of investing that takes into account not just the financial returns, but also the company's impact on the environment, society, how well it's run.
Like investing with a conscience then, making sure your money is supporting companies that are doing good.
Exactly. And a lot of people believe that companies with strong ESG practices are actually better investments in the long run. They're more sustainable, more resilient to risks, and more likely to attract and keep good employees.
It makes sense. Companies that are ahead of the curve on those things are probably going to be in a better position for the future, right?
That's the idea. And some big-name investors like Larry Fink, who runs BlackRock, he believes ESG is not just a trend, it's essential for creating long-term value. He says that companies that ignore ESG are putting their businesses at risk. So it's not just about feeling good, it's about making smart investments.
It's aligning your portfolio with your values and maybe even doing well financially in the process. But even with the best intentions, you can't escape risk in investing, can you?
Nope. Risk is like the flip side of the coin. Can't have one without the other. And everyone's got to figure out how to manage it.
Some people seem to embrace risk, like John Paulson with his big short-selling bets.
While others, like Seth Klarman, they're all about minimizing risk, looking for that margin of safety to protect against losses. But no matter what, understanding risk, managing it is crucial.
So how do these top investors deal with something as complex as risk?
One classic strategy is diversification. Don't put all your eggs in one basket, right? By spreading your investments across different asset classes, industries, different parts of the world, you reduce your exposure to any single risk. They also do their homework, thorough due diligence, analyzing the financials, the management team, the competition, anything that could affect the business.
Not just going with your gut, but backing it up with research.
Yeah, and they're constantly watching their investments, looking for warning signs, changes that might mean they need to adjust their strategy. It's active management, not just setting it and forgetting it. But it's also about knowing your own limits, your own risk tolerance. Don't invest in stuff you don't understand, and make sure you're comfortable with the level of risk you're taking.
So it's about matching your investments to your personality, your comfort zone.
Exactly. And having a plan for when things go wrong.
Mhm.
Because even the best investors mess up sometimes. It's how you deal with those mistakes that really matters. As we've been talking about all this, I keep coming back to the importance of having a clear investment philosophy.
A philosophy, like a personal mission statement for your investments almost.
Right. A set of guiding principles that help you make decisions, handle the ups and downs of the market, and stay true to your long-term goals. It's like your compass, guiding you in the right direction, even when things get rough. Every investor we've talked about, they have their own philosophy. Ron Barron focusing on growth and innovation, John Rogers Jr. with value investing, they each found a philosophy that works for them.
And it's amazing how those different paths can all lead to success.
But the important thing is to find a philosophy that aligns with your values, your risk tolerance, your vision for the future. It becomes your guiding star, helping you through all the complexities of the market.
So it's not just about following the hot tips or chasing the latest trends. It's about having a deeper understanding of what you're doing and why you're doing it.
Now, another cool thing we've seen is the art of deal making. These investors, they're not just buying stocks, they're negotiating complex transactions, buying companies, building businesses.
Sounds like high-stakes poker. Knowing when to hold them, when to fold them. What have we learned about this from the pros?
One thing that sticks out is relationships. They all have these massive networks built over years and years. Industry experts, bankers, other investors, they're always nurturing those connections, going to conferences, meeting management teams, staying plugged in.
Always networking, even when they're not actively looking for a deal.
Right. And those relationships often lead to opportunities that they wouldn't have found otherwise. It's not just knowing the right people. It's about trust, building rapport, having a reputation for being fair.
People want to do business with people they like and respect, especially when there's a lot on the line.
Exactly. And then there's the negotiation itself.
Yeah.
Knowing how to put together deals that work for everyone involved. They're looking for win-win solutions, which means compromise, creativity, thinking outside the box.
It's like a puzzle, finding those pieces that fit just right.
But it's also about knowing when to walk away. If the terms aren't good, if something feels off, they have the discipline to say no, even if it seems like a really good opportunity.
They're not letting FOMO, that fear of missing out, cloud their judgment.
Sticking to their principles. Only doing deals that fit their criteria. But even with the best relationships, the best negotiation skills, the world's changing, right? Technology's transforming investing.
Technology, like are algorithms taking over Wall Street?
In a way, yeah. It's changing everything, from how we analyze data to how we trade, even how we manage portfolios. These investors, they're at the forefront of this revolution.
They're using like super sophisticated software to crunch mountains of data,
Yeah.
spot trends that we humans would miss, making those split-second decisions.
Algorithms are executing trades in milliseconds, taking advantage of these tiny market inefficiencies that we wouldn't even see. And online platforms are connecting investors, raising money, managing funds in ways that we couldn't have imagined just a few years ago.
Like a digital arms race, and these investors are arming themselves with the latest tech.
But there are concerns too, right? Some people worry that relying too much on technology could make the market unstable, that algorithms could cause flash crashes or make things even more volatile. But the truth is, technology is a tool. Like any tool, it can be used for good or bad.
It depends on the people using it. It's up to them to use it responsibly.
Exactly. And these investors, they're embracing technology, but they're using it to enhance their abilities, not replace their judgment. They're learning to use data and algorithms while still keeping human oversight, critical thinking.
It's about finding the right balance, the human and machine working together. Using technology to make our strengths stronger and our weaknesses less impactful. But even with all the fancy tech, you can't ignore the human factor, the psychology of investing.
Right. Investing isn't just about numbers and spreadsheets. It's about human behavior, those often irrational emotions that drive our decisions. Understanding that psychology is just as important as understanding the financials.
Because even the most rational investor is still a human being, and we're all prone to biases, emotions, and sometimes just plain irrationality.
True. And one of the biggest traps is overconfidence. We overestimate our abilities, underestimate the role of luck. This can make us take too much risk, hold on to losing investments for too long.
Like we're wearing rose-colored glasses, seeing the market in a distorted way.
Confirmation bias is another one. We look for information that confirms what we already believe and ignore evidence that contradicts us.
It's like living in an echo chamber, only hearing what you want to hear.
And that's dangerous, especially when you're wrong. Then there's loss aversion. That feeling that losing hurts more than winning feels good.
Makes sense. It's like a primal instinct, that fear of losing what you have.
It can make us too afraid of risk or make us sell winners too early. And let's not forget herd behavior, that urge to follow the crowd, even if they're heading off a cliff. This is what causes bubbles and crashes, investors piling in or out based on emotion, not logic.
Like a flock of birds all moving together, even if they're flying into a storm.
So how do we beat these psychological traps? Awareness is key, right? If you understand your own biases, you can start to counter them.
It's like shining a light on those subconscious impulses, bringing them into your conscious mind.
And having a disciplined process. Following a set of rules, guidelines, it helps reduce the impact of emotions, helps you make better decisions. It's like guardrails to keep you on the road.
Like a framework, a structure to guide you, especially when the market's going crazy and your emotions are running high.
And don't just listen to people who agree with you. Get diverse perspectives. Talk to other investors. Read different opinions. Challenge your own assumptions.
Get out of the echo chamber, expose yourself to different ways of thinking.
That way you can understand more, make better decisions, and ultimately become a better investor. You know, one thing that seems to connect all these ideas, from overcoming biases to handling market swings, is patience.
Patience. That seems almost too simple. In a world where everything's moving so fast, is patience really that important?
Absolutely. Investing is a marathon, not a sprint. And patience is one of the most valuable things an investor can have.
It's like being a gardener, nurturing those investments over time, waiting for them to grow. I'm remembering that Warren Buffett quote, "The stock market is a device for transferring money from the impatient to the patient."
Exactly. And a lot of the investors we've talked about, they agree. John Rogers Jr., the value investor, he believes in buying good companies that are undervalued and then just holding on to them for a long, long time. He lets them mature, knowing that real value takes time to develop.
But in today's world, where everyone wants instant gratification, everyone's looking for the next big thing, patience feels like a lost art.
It can be tough. We're bombarded with news, market ups and downs. It's easy to get caught up in the short-term stuff. But successful investors learn to ignore the distractions. They focus on the bigger picture.
Not checking their portfolios every few minutes, they're playing the long game.
But patience doesn't mean being passive, right?
Mhm.
It means being active, doing your research, analyzing, watching the market, always learning, adapting.
You're ready to act when the right opportunity comes, but you also know when to wait, even when it feels like everyone else is making money.
Because the investments that pay off the most, often they take time. Patience also applies to buying and selling. Waiting for those market drops, those moments when everyone's panicking and prices go down, that's when you find the hidden gems.
It's like waiting for a sale, right? You know the good deals will come eventually, so you're patient and ready to jump on them when they do.
Yeah, it takes discipline to resist buying when everything's expensive and everyone's excited. The best time to buy is often when nobody else wants to. And the same goes for selling.
You're not chasing the hot stock, you're letting your winners run, but you also know when to cut your losses if things go bad.
You're not letting your emotions make decisions for you. You're making those tough calls based on your analysis and your plan.
So patience is more than just a virtue, it's a strategy, a key ingredient for success in investing.
It's about being able to see beyond the immediate future, having the discipline to stick with your plan, and knowing when to act and when to wait.
Now, as we've been going through all these ideas, one thing that's really stood out is that successful investors are always learning. They're constantly expanding their knowledge, getting better at what they do, and adapting to a world that's always changing.
They're like sponges, soaking up new information, challenging what they think they know, and looking for different points of view.
So how do they stay ahead of the game? How do they keep learning and growing in this crazy world?
Reading is a big thing for them. They devour books, articles, research, anything that gives them good insights and knowledge.
They're like intellectual omnivores, eating up all kinds of mental food.
And it's not just about finance. They're reading about history, psychology, technology, you name it. Anything that can help them make better investment decisions. They're building this mental network, connecting the dots between different fields.
Seeing the world through a much wider lens, making connections that other people might miss.
And they're not just reading by themselves. They're constantly networking, going to conferences, meeting other investors, getting into those lively discussions and debates.
They're like intellectual cross-pollinators, sharing ideas and insights.
And they're not just talking to people who agree with them. They actively seek out different opinions, challenging their own assumptions, sharpening their thinking through those intellectual sparring matches.
It's about pushing yourself out of your comfort zone, exposing yourself to different ways of thinking.
And learning isn't just about taking in information, it's about doing stuff. These investors are always trying out new ideas, different strategies, and changing their approach based on what they learn.
They're not afraid to make mistakes because they see mistakes as chances to learn and get better.
It's like a cycle,
Yeah.
constantly tweaking and adjusting until you find what works. They're embracing that process, knowing that there's always more to learn and new ways to improve.
So it's not just about knowing a lot, it's about actually doing it, testing it out, and constantly evolving.
Exactly. Turning theory into practice, being willing to adapt as the market changes and you get new information.
Because the world of investing never stays the same. The only way to stay ahead is to keep learning and growing.
And to have that long-term vision, to understand where the world is going and how to position your investments to take advantage of those trends.
It's like being a futurist, anticipating the changes that are coming and getting ready to be on the right side of history.
And a lot of the investors we've talked about, they've emphasized that long-term perspective. Ron Barron, he invests in companies that are shaping the future, like Tesla, while Michael Moritz, he sees venture capital as a way to support those next-generation disruptive technologies.
They're not looking at the next quarter's earnings, they're thinking years ahead, decades even.
Right. And to develop that kind of vision, you have to really understand the things that are shaping the world. Technology, demographics, politics, everything.
Connecting the dots, seeing the bigger picture, understanding the ripple effects of those changes.
And it takes patience, because those big shifts can take a while to play out. It also takes a willingness to go against the crowd, because the investments that make the most money are often the ones that nobody else believes in.
It's about thinking for yourself, challenging assumptions, and having the guts to bet on your convictions, even when everyone thinks you're crazy.
And sometimes, those crazy bets are the ones that turn out to be brilliant.
As we've been looking at these individual stories, one thing I've noticed is that even the best investors don't do it all alone. They have teams of talented people to help them.
Investing isn't a solo sport, it's a team effort. And building a good team is more than just finding a bunch of smart people. It's about finding people whose strengths complement each other, who challenge each other's weaknesses, and who are all working towards the same goal.
Like having a brain trust, where the collective intelligence is greater than any individual.
You want people who are passionate about investing, who are always learning, getting better at what they do, and pushing each other to excel.
They're like intellectual athletes, constantly training and striving to be the best they can be.
And just as important as individual talent is the ability to work together well.
Hmm.
You need team players, people who are willing to collaborate, share ideas, and support each other.
It's not about egos, it's about working towards a common goal, and that requires trust, respect, and a shared sense of purpose.
And of course, a good team needs a strong leader, someone to set the vision, inspire the team, and create a culture of excellence.
Like a coach, leading the team to victory, but also knowing when to step back and let the players shine.
And that leader needs to be able to make the tough calls, use resources effectively, manage risk, and navigate all the challenges that come up along the way.
They're the captain of the ship, guiding the team through smooth sailing and rough seas. But even with the best team, sometimes you need that extra help, an outside perspective. And that's where a mentor comes in.
Having a mentor can be so valuable, especially when you're just starting out. It's like having a guide, someone who's been there and done that, who can help you avoid the pitfalls and find the opportunities.
We've heard so many of these investors talk about the impact their mentors had on them. John Rogers Jr. learned from Warren Buffett. Orlando Bravo was mentored by the pioneers of private equity. It's about finding someone who's walked the path you're on and can offer real-world insights.
A good mentor can do more than just give advice. They can provide support, encouragement, and be a sounding board for your ideas. They can help you develop your skills, expand your network, and avoid making those big mistakes that can cost you a lot.
So what makes a good mentor?
They should have experience and expertise in what you're interested in. They should be generous with their knowledge and insights. And maybe most importantly, you should respect and trust them. Their judgment should matter to you, and you should value their opinions.
It's about having that connection, that mutual respect.
And finding a mentor, it's not always easy. Sometimes it's just luck. Being open to opportunities, going to industry events, meeting people who have the experience you're looking for,
It's about putting yourself out there, networking, building relationships.
and being proactive. Reach out to people you admire. Tell them you want to learn from them.
Take the initiative. Don't be afraid to ask for help. But even with the best mentor in the world, success in investing really comes down to one thing: discipline.
Discipline. That
Yeah.
ability to follow your plan, control your emotions, and stay the course, even when the market's trying to knock you off track.
That's what separates the amateurs from the pros, the short-term gamblers from the long-term investors.
And all the investors we've talked about, they have that discipline in different ways. They have clear philosophies, knowing what they're looking for and not letting their emotions or market noise distract them. They have processes, systems for analyzing investments, managing risk, making decisions. And they have the mental toughness to control their emotions, not letting fear or greed make choices for them. They stay calm and collected, even when the market's in chaos.
It's like an athlete, training consistently, listening to their coach, and staying focused on the ultimate goal.
And discipline means being patient, waiting for the right opportunities, not chasing quick wins. It means knowing when to cut your losses, accepting that you won't win every time, and not letting your ego get in the way of making good decisions.
Sometimes the best move is not to move at all.
And discipline isn't just about rules and guidelines. It's about having that inner strength to keep going when things are tough, to stay committed to your goals even when the market's testing your resolve.
It's about weathering the storms and coming out stronger on the other side. But beyond discipline, beyond strategy, there's something else that's important, but we don't talk about it enough when it comes to investing. Ethics. Ethics, doing the right thing, not just for yourself, but for your clients, your investors, and the community.
Building a reputation based on integrity,
Yeah.
trust, being responsible.
The investors we've talked about, they show those ethical principles in different ways. They're transparent, they don't mislead people, and they're honest about the risks.
They're not trying to cheat the system or make a quick buck by hurting other people.
They're building their businesses on honesty and integrity.
And they treat their clients well. They listen, communicate clearly, put their clients' interests first.
They're not just seeing dollar signs, they see people. They realize that behind every investment, there are real people with their own hopes and dreams and financial goals.
Building relationships based on trust and respect.
And they do business the right way. No insider trading, no manipulating the market, no taking advantage of others. Playing by the rules, setting a good example.
And a lot of them go even further. They're involved in philanthropy, using their wealth and influence to make a positive difference in the world.
Giving back to their communities, supporting causes they believe in, using their success to help others. It's pretty inspiring to see that level of commitment to doing good.
It says a lot about who they are and what they value.
Now, as we've been unpacking all these insights, one thing that's super clear is that successful investors have a plan.
A plan. It's like a roadmap, right? It guides you towards your goals and keeps you from getting lost. Investing without a plan is like sailing without a compass. You might end up somewhere, but it's probably not where you want it to be.
So what are the essential parts of a good investment plan?
You got to start with your goals. What are you trying to do with your investments? Retirement, buying a house, your kids' education, something else. Knowing where you want to go before you start is crucial.
Gives you direction, something to aim for.
Once you know your goals, you can figure out how to get there. What kind of investments make sense for you given your goals and how much risk you're comfortable with? How long do you have? How will you diversify? How will you track your investments and make adjustments as needed?
Like charting your course, figuring out the steps to reach your destination.
And your plan should include how you'll manage risk. What will you do when the market goes crazy? How will you protect your money and minimize potential losses?
Like having a backup plan in case you hit a storm.
Just as important as having a plan is being able to adapt, though. The market's always changing. Your plan needs to be flexible enough to change with it.
Like adjusting your sails to catch the wind, being ready to change direction as the market currents shift.
Creating an investment plan might seem daunting, especially when you're starting out. But don't let it overwhelm you. There are tons of resources to help, from advisors to books to online tools.
The important thing is to get started. Even a simple plan is better than no plan at all.
And remember, it's a living document. It should change as your life changes, as your goals change, and as you gain more experience and knowledge.
It's a journey, not a destination. And speaking of journeys, one of the most important things in investing is to stay informed, keep learning and growing as the world changes.
Right. The world of investing is always moving, constantly shifting, and staying informed is essential for making good decisions. It's like being a detective, gathering clues, putting the pieces together, trying to figure out what's going to happen next.
So how do these top investors stay on top of things? How do they stay informed when there's so much information coming at them all the time?
They read a lot. They're always reading newspapers, magazines, research reports, anything that can give them valuable insights and knowledge.
They're like information vacuums, sucking up every bit of data they can find.
And they're not just reading about finance. They're reading about technology, politics, demographics, anything that can impact the market. They know that the world's all connected, and events that seem unrelated can have ripple effects that spread across industries and types of investments.
They're building that broad understanding of how the world works, seeing the connections that other people might miss.
And they're not just passively reading. They're actively engaging with the information. They're talking to experts, networking with other investors, industry leaders, and analysts to get their perspectives.
They're tapping into the collective wisdom of the crowd, but they're also thinking for themselves.
They go to conferences, seminars, and workshops to stay up to date on the latest trends and ideas.
They're lifelong learners, always trying to expand their knowledge and get better at what they do.
But staying informed isn't just about taking in a lot of information. It's about being smart about it. You can't believe everything you read or hear.
You have to be skeptical, question assumptions, dig deeper, and look for evidence.
Like a journalist, right? Checking your sources, verifying facts, separating what's real from what's not.
With information coming from everywhere these days, it's tough to know what to trust.
It's true. Staying informed can feel like a full-time job, and sometimes you feel like you're drowning in it. But you got to be selective.
It's not about reading everything. It's about finding the stuff that matters, the stuff that's relevant to your goals and your strategy.
Exactly. Finding the signal in all the noise. Identifying the key trends, the things that are actually going to impact your investments.
It's about tuning out the distractions and focusing on what really makes a difference. But I think there's one more thing that's crucial for success in investing, and that's passion.
Passion, huh? You mean like getting emotionally attached to your stocks?
Not exactly emotional attachment, but a real interest in the businesses you're investing in, the industries, the whole process. It's about being curious, engaged, excited by the challenge of it all.
Ah, I get you. And, a lot of the investors we've talked about, they have that passion, that spark. Ron Barron, he's known for his enthusiasm. It's almost contagious. He truly believes in the companies he picks, gets excited about their potential.
It's inspiring. And Michael Novogratz, he's always been drawn to the new, innovative stuff like crypto or other disruptive technologies.
Yeah, passion is a powerful motivator. It pushes you to learn more, work harder, take those smart risks. Helps you stay committed even when things get rough. It helps you get through those tough times and come out stronger. And it can make the whole investing thing more fun and rewarding.
Because let's be honest, investing can be tough, sometimes it's frustrating, but if you have that passion, that belief in what you're doing, it makes it all worth it.
Totally. And finding your passion, it's a journey in itself, right?
Yeah.
It's about trying different things, experimenting, seeing what clicks. What are you naturally interested in? What industries, what companies really get you excited?
It's about finding those investments that align with what you care about, your vision for the future. And when you find that alignment, it can be really powerful.
It's like finding your purpose in investing, you know? So as we wrap up this deep dive, let's take a minute to think about what we've learned. We've covered a lot, from the basics to the cutting edge stuff, from value investing to growth investing, from managing risk to making deals.
We've heard from some of the most successful investors out there, each with their own way of doing things. We talked about having a long-term vision, being disciplined, controlling your emotions, learning from your mistakes.
Yeah, and we explored the human side of investing, the psychology, the emotions, the biases that affect our decisions. It's been quite a ride.
So what's the big takeaway? What's the one thing you hope people listening will remember?
I think it's this. Investing isn't about reaching a destination, it's about the journey. It's about constantly learning, adapting, growing, and changing as the world changes around us.
It's about embracing that challenge, that constant state of flux, and knowing that there's always something new to learn, a new strategy to try, a new way to get better.
Whether you're a seasoned investor or just starting out, the important thing is to stay curious, to keep asking questions, challenge what you think you know, and seek out different perspectives.
Because the world of investing is full of surprises, good and bad. And the only way to handle those ups and downs is to be prepared, to be flexible, and to always be open to new ideas.
And remember, it's not just about making money, it's about making a difference. It's about using your money to support the businesses and ideas you believe in, to create a better future for yourself and for the world.
It's about aligning your investments with your values, using your resources to make a positive impact. So invest wisely, invest ethically, and invest with passion.
Until next time.